towards those targets. And to your point, historically speaking, if you look at bear markets.
All right. All right, guys. Good morning. Good morning. Welcome aboard to the morning. No, my apologies. I was just typing up in the Discord for Investment Club, just answering some questions. All right, my apologies there. Good morning. Good morning. It is September 23rd on a Friday. Watching the markets this morning, I'm wearing my New York Yankees hat this morning. The Yankees did clinch a playoff spot. Judge did not get 61. He's sitting at 60 home runs. They played the Red Sox last night, so that's always nice to see them win. Let's go ahead and go around the horn this morning and go over the futures. Dow futures are down 370 points off their lows. Take a drink. Nasdaq futures down about 1%, doing better than the Dow and the S&P. S&P there 37.29. Looks like SPX will break the lows of June, but S&P futures are still holding up above that. We'll take a look at that here in a second. I'll maximize the sell. Russell 2000 down about 1.36%. Crude oil down 4%, and gasoline down 4.77%. Now, in regards to equity futures, what has changed overnight really was the Bank of England. Their Bank of England raised rates, and Parliament, or I believe the Prime Minister, said they're going to cut taxes to be a more stimulative effect. So it's kind of one hand and the other. European markets are down. Again, that's moving over to the American markets at this point. Let's go and bring up CNBC, and I haven't done this in a while. If you remember, if you're an OG follower, I'm talking about like 2015, 2016. I used to do the morning note with TOS also, but I would also go over CNBC, the European markets. The German DAX, that's down 273 points. That's down 2%. The British FTSE, that's down 2% this morning. The French CAC down 1.77%. So you could see just crushed along the lines on the European banks, European stock market, excuse me. And the reason that is now we're getting conflicting kind of issues here. Now the English or the British want to cut taxes, which is a stimulative effect. Again, that actually increases inflation, but they're increasing rates in order to cut inflation. That's why the market is like, what are you doing? How about this? Let's take a look at this real quick. I know we don't do too much on Forex, but again, it matters when it matters. And look at the weekly chart, max chart on again, this is as far as I can go as 1990. We haven't been the British pound hasn't been this low relative to the dollar, I believe, since 1980. I read this morning on Bloomberg. This is since 1990, and again, we're still at the bottom. We may get to the point of parity where it's one for one. So again, anyone who's American traveling to Europe, you're loving this right now. Anyone who is from Europe that has business in the United States, it's a tough one. Or business at home, but again, probably works in the U.S. That's going to be tough. I don't think many people do that, but again, maybe you're doing business in the U.S. and you have a lot of sales in England or a lot of sales in Europe. That's going to hurt your bottom line too. International people, they get paid in that currency, British pound, euros. So if you're accepting euros or British pound in your business, you're taking a loss on those Forex swaps. So again, maybe you don't care about the stock market, maybe you don't care about the Bank of England, but it matters to your money because now we're going to get foreign exchange issues. Here's the problem now. Now we have a foreign exchange problem. Now we have to see if the central banks are going to intervene like the way the BOJ said they would. I still don't know what that means, what they're going to do. But again, maybe the Bank of England, maybe the European Central Bank starts doing some kind of a stop or a stop a placement, kind of a bottom in a sense to do some currency intervention. Uh, Again, I don't know what that plan may be. Who knows if that happens over the weekend? And I pivot to this. Look at gold futures this morning. Even with all this selling off, all of this happening, and this is a weekly chart. Let me get to the daily or the weekly. Look at gold. Gold again, since 2000, since the beginning of January, it is red. So even the safe haven of gold is not holding up. Again, not as down as the S&P, sure, but again, you could see even gold is under pressure. Everything is on the US dollar. The US dollar, it is too damn strong. You know the saying, rents are too damn high. The dollar is too damn strong and it needs to pull back in order for commodities to bounce back, in order for equity markets to bounce back, for Forex currencies to bounce back. Again, this is not sustainable. So, what does that tell me? That tells me that, of course, the June lows could be hit. The question is, does it bounce there? The question is, if there is there any kind of government intervention outside the U.S. that may change this trajectory for the dollar? Again, this has nothing to do in regards to American control. Obviously, they're doing rate hikes, but it's the other countries that are slipping so badly. The yen against the dollar, the euro against the dollar, the pound against the dollar, and so on and so forth. Interesting enough, Bitcoin is still kind of hovering around 19,000, doing better than its stock market peers in Europe. 18,970. Ethereum at 1304, down 1.44%. Let's take a look at silver, down 2.36%. Copper being a barometer of economic growth. You know, usually copper prices soar when you get an expansion. That's at $3.35, down 3.40%. Let's go ahead and go over 10-year yields. 10-year yields, at least for the time being, are pulling back a little bit. I mean, they are red, at least the yields pulling back. So at least some kind of glimmer of goodwill as the S&P is bouncing as we speak. Right now, we're at around 37.35 on the future side. Let's take a look at the VIX together. Well, good news, at least the yields are pulling back. Good news. The volatility index, key level is 30. We had that VIX print at 3018 during the Fed this week. We're rejecting 29. I mean, I'm looking at it here again. We're off the lows. I know, take a drink. I say that all the time on Twitter. But really, the target is we really don't know what could happen. That's something that you could say. It's very humbling to say we don't know. This week has been an absolute tough one as well. Been a tough one all around. Looking at here, I did AMD puts yesterday personally. Nick went ahead and shared it with the team. I didn't have that much conviction to go ahead and send it as a signal, but it did work out. I'm kicking myself that it wasn't sent a full signal because it would have been great. It did break down, but again, you could see now that we're starting to bounce back. Look at this bottom here, at least on the wick side. You could see here around 37.40, 43. But again, you have the June lows at 36.39. Now, what you could do here is just short here, fall asleep, and see if it bangs, if it hits. In the option side, you don't have that luxury. On future side, sure, that'll get you to around 100 points. And that's would be a great target. The question is, do you want to hold that risk over the weekend? If this was a Thursday, I would have maybe looked at that break at 37.40 and been like, yeah, maybe I can ride that down. But for next week, again, if we're still above those June lows, I would definitely want to short. But with Saturday and Sunday, again, no market action. We don't know what governments may say. Powell speaks today at 2 p.m. Who knows if he talks about Forex currencies overseas, and maybe he has a comment on the BOE's stimulative tax cut nature. Maybe they talk about this in Congress. Now there's so many options out there. There's so much going on. The market is really not prepared for this kind of currency devaluation across the board, at least in the other side of the globe. But again, at least in the United States, in regards to the dollar, at least we're getting some kind of benefit on that. But in terms of the equity markets here, 37, 34, we're kind of bouncing above. Let's go ahead and take a look at some RSI numbers on some really key macro things, macro charts. Let's take a look at S&P futures on the hourly, right around 35, near oversold. Let's take a look at the daily. You're right at 30. That is literally oversold. Last time we got to that level was the June low, and we bounced above it. Do I want to run out and buy calls this very second? No. Do I want to run out and buy stock this very second? No. But I did buy SPY-G yesterday, so I want to go and pivot to this point. I had a member of mine on an investment club saying that he was going to deposit his 401k, that he needed the cash. And I've always said, if you need the cash, stocks be damned. You got to live. You got to eat. You got to put a roof over your head. You got to drive to work. Again, stocks are there. It's just money at the end of the day. It's just an asset. If you have to sell, again, that's just the nature of the beast. You just got to sell, and you move on, and then you get an opportunity to get back in. I've been doing dollar cost averaging now for a while now. It's just a habit, like brushing my teeth and waking up in the morning, doing the morning note. You don't even think about it. That's kind of how you want to do it. Instead of making a 401k at zero, I propose to just lower the amounts or just put it in a fund that has a cash equivalent. Doesn't have to be S&P 500 fund or emerging markets or something like that. Most 401k portfolios, again, you may want to speak to HR for a sheet if you work at a company. What would be, in a sense, their cash equivalent. Some of them have government bonds, but even that has dropped in value. So again, you have to be careful what you're putting in. But at least for the tax benefit, you can get the 401k. Again, it doesn't use pre-tax dollars. So again, that benefit still matters. Let's go ahead and take a look at S&P futures. Again, that 30 reading there. Let's take a look at Nasdaq. Nasdaq is nowhere near the June low. How's that? 11,068. So even tech's kind of holding up a little better, right around at 32. Again, still oversold. Let's go and take a look at the Russell. Russell's still around oversold. So the indexes are kind of telling you we're getting to an oversold condition. You can stay oversold. Don't think, or you can get even more oversold. I don't want anyone to think that just because something's at a 30, oh, it has to bounce. Yeah, eventually, but again, not immediately. So again, remember, support, just like anything else, is not a piece of hardwood. It is like a mattress. It can sink in for a bit and then bounce. So right now, looking at the market, again, RTY, Russell's at 1706 at a 31 reading. Could you go ahead and here buy calls? Again, you need to be, the time factor is very key. You need to see what's going to happen moving forward. We have Powell at 2. It just seems right now that just kind of holding steady, holding pat, waiting to see where things go is okay. Cash is a position. And I think that's probably the most prudent thing to do here is just hurry up and wait until an opportunity arises. I mean, in regards to the S&P, if you start breaking those lows, 36, 39, you almost have to. Short, of course. I mean, you're going to keep continuing to go down. That was the last line of defense for the S&P market. If we expanded even more, how about the 3-week? Now you're the weekly charts. Now you're talking about let's see if we broke 36, 39 on ES. That is your support. Again, you could see that will get us to levels not seen since what? This is 2021 of January. Wow, we would round tripping all of that. And again, we're nowhere near the COVID lows. That's all around 2206. Goldman Sachs also cut their S&P forecast. I think everyone has. So have I. I mean, I had a level for the end of the year. I thought the bottom would be 3,900 in terms of this bear market rally, but it was just a bear market rally. As we saw, we're still below the 200-day on the weekly. If we bring up even more of a chart here on a weekly basis, you could see now we're talking about, I think this is now on a weekly chart, weekly candle chart, and this is based on a multi-decade. So if we do that, you could see 3581 being the 200 moving average. Not a bad target to have. Some banks, I think it was Bank of America that had 3,500. They said nibble at 3,700, eat at 3,500, and gorge at 3,000. Now that's their call on Bank of America. We'll have to see what happens moving forward. Keep in mind seasonality. We talked about September being a weak month. Again, don't be surprised due to the seasonality of the Q4. October, we do rally a little higher. Again, really the move in terms of the contrarian move or the higher upside move, the quicker money will be to the upside, again, against the trend. Counter trends tend to pay out more in terms of options. If you just, unless you get some violent volatility to the direction that you want. For example, if you were short last night, you're going to get some nice money in your puts if you own some for today expiry, for example. Again, it's all about demand. The traders will want those options in order to cash them in, for example. Let's answer some question, Bitcoin and BlackRock. GM, good morning. I don't know, sometimes it's good morning or General Motors. Good morning. Thoughts on Microsoft and '08 and Apple now charts really similar. In regards to the '08, the one that stands out, and I've been reading about it, was Cisco and Nvidia. And we could do that together. Let's go ahead and go to Cisco, and we'll expand it to that weekly chart that gets us back before the 2000s. I think it's before the 3 week. Let's see. Let me get to the 20-year daily chart. So this doesn't get me much. Let's go to the max chart, and we'll start from 2000, and we'll go ahead and compare. So we're going to go to add study. We're going to go to compare with symbol, and we're going to go to NVIDIA. Pretty similar kind of trajectory. You see that top there, and you see that there as well. Obviously, we did bounce back in terms of Cisco. Took about, just about 20 years to get there. But again, a very, very, very close, similar map to NVIDIA that we had today, well, NVIDIA's today, and in Cisco in 2000. Now, you could take that information with what you like. 2008 was a systemic risk event in terms of, the housing crisis and everything. Unless I mean, I don't see any kind of systemic risk, really not in the United States, anyways. Really, just being, at this point, you're just at a very restrictive monetary policy, which is to drain liquidity out of the system. The idea is to get cash out of your hands to kill speculation so prices can get back under control. That's really it. And so far, the Fed is getting what it wants. And that's what Powell wants to do, and the committee. They're willing to keep going, keep that pain going to destroy inflation in their mind. This is what Paul Volcker did. But Paul Volcker did not go the whole way. He did not get to his CPI target during this time in the 80s. In 82, inflation was still running hot, right above 8%, 9% in 82. And they still cut rates. That's why here I'm cautious, because can I just be honest? I don't trust the Fed. There's still political leanings. There's still, things could change very, very quickly. A part of me kind of says, not even a hope thing, but just the idea that they could screw everyone over, thinking that we're going to go to 3,000 or 3,500. And then some kind of really dumb accommodative policy comes out to just flip the narrative. The Bank of England's are already starting that now. Not only they're raising rates, now they're going to cut taxes. Again, it's one hand is not knowing what the other is doing. What is to stop the Fed from doing the same? And then again, their currency gets devalued, the British pound. Isn't that kind of what the Fed would want if we wanted some stimulative policies, excuse me? You would want to kill the dollar, right? What better way to do that than to cut rates or have at least a tax cut to get more money into consumers' hands? So that Bank of England thing kind of really threw me for a loop there, because I just thought they were just going to continue to rate cut and cross their fingers that Russia and Ukraine would be fine. But they went for it. They said that they want to do a tax cut. Again, that's stimulative. That's going to create inflation while they're trying to fight inflation. So a real head scratcher. I sold AMD puts at the beginning of the month at 75. Damn, it hurts. 2024 elections can't come fast enough. I mean, at the end of the day, my man, profit is profit. Downgrade from JPM is huge. Again, now the banks are starting, the hedge funds and the big banks are starting to see that, hey, we're going to go lower. Pretty late now. I mean, where was this in spring, other than Morgan Stanley was really the only one? But looking at the market in general, they were pretty late to the party too. Remember their price targets, the average price target last year for 2022 was right around 5,000. And that didn't change until really summer for the most part. So again, they're running on a lag as well. So is the Fed. So again, could that change too? Could we get an end of the year rally based on seasonality? Possibly. Could we go to 3,000? It is such a binary approach here that you have the bond markets just absolutely broken and you have the stock market absolutely broken. There is no hedge. There is no insurance other than puts, other than staying short or holding cash. At this moment and juncture, what do you do? Really, in technical analysis, the only thing you can really point to at this very moment is really two charts on the S&P. The June lows, which the S&P 500 spot will break today, and of course that 200 moving average on a multi-decade basis, which will get you to around 3,500. Now, again, what a price to you may think as, oh my God, the world is over, people are going to go ahead and look for opportunities too. Remember, these hedge funds and these banks just can't hold cash forever. They have to own stocks. We're in a buyback blackout period at least until October. We have earnings coming again relatively soon. I believe that'll come in November. So again, some things are moving forward in terms of news other than the Fed and CPI. That's all we've been kind of waiting for moving forward post earnings. Earnings were okay, relatively decent. Are you starting to see fear take over? There was a the CNN Money uh, number of the fear index, and it's generally right at fear, right around like that 28, 30 level. Are we at a point of capitulation? That Goldman Sachs note, it seems to be it. Do I want to risk capital today in order to test that theory? Not really. I think it's more prudent just to wait, especially for a weekend. God, the Bank of England really screwed it up because I thought that if they were just going to raise rates, okay, then it's going to be just one of those run of the mill cycles. Now you're going to get tax cuts. Now their currency is actually getting completely nuked. It's going to be just the United States standing firm with the most valuable currency in the world, and they're still taking them away from the marketplace globally with raising rates. The dollar, it's I mean that's where we are. And it's kind of baffling to see that Europe just one war just completely took them out of it. How important energy is. Thoughts on Chainlink and smart contracts outlook for crypto? Crypto is going to run exactly with the Nasdaq. It's just a higher beta form of the Nasdaq. That's all. Look at Bitcoin, look at Nasdaq. It's the same exact thing. If you think risk assets will bounce back within the next 12 months, 24 months, then yeah, you can own crypto. I still do. I still dollar cost average. Sometimes I feel like a moron that I still buy some every week. But again, I still think crypto long term is the future of money. I really do, especially with all these currency devaluations. I mean, they could just print more. In terms of crypto, I know there's a lot of trash coins out there. Bitcoin, Ethereum to me is still that Coke, Pepsi sort of thing. I still have the Graph. I still have Shiba. I have tons. And my portfolio that just been auto investing over time. Again, we'll see if I look crazy in 3 months, in 3 years, or 30 years. For that case, I'll just give them to my children. Who knows? AMD, I was going to add a position. However, there was so much room to fall. Yeah, I mean, AMD, we were talking about that the other day, AMD and NVIDIA, which is better. I showed you the chart with Cisco and NVIDIA, very similar patterns to the 2000s. But the idea is semiconductors in demand. Really, the semiconductor issue there was that we didn't have enough supply. They're still in demand, they still get orders. The issue is that they ran so quickly, so fast. And again, when you have such high demand, and everyone chasing return in a low interest rate environment, you're going to get a push in a crowded trade like semiconductors. It doesn't mean semiconductors or the semiconductor industry in general is trash and that's over. It's just that it became overvalued. A home is still a home. It just depends on how you value it. I think NVIDIA, I still own NVIDIA, I still own AMD long term. I like them both. They still generate money, they still make profit. They may not be at their valuations they once were, true, but that's the name of the game. And again, do valuations reset? Absolutely. When you have a different monetary policy, whether you're going from restrictive to accommodating, from accommodating to restrictive, it always changes the viewpoint where, again, the simple question I can ask you every day is, do you want to take a 2-year treasury yield paying at 4.2%, four and a quarter, let's call it, or do you want to invest in the stock market for the next 2 years? And again, look at the risk, look at the reward. That kind of holy grail we want is low risk, high yield. Kind of difficult, but 4% in this marketplace with relatively, well, pretty much no risk other than inflation risk. I mean, a lot of traders are not taking that yet. At least today and on the 10-year, yeah, we're getting at least some buying, maybe some buying to close. But that's the question every day the market is asking. The 2-year, the 10-year, can I buy bonds at a cheaper price, get a better yield, and have a safe risk of return, or do I just put in equities in the S&P market with risk involved, with a tightening Fed, and now global slowdown? We have the geopolitical war of Ukraine and Russia. Not the best time right now, that's for sure. But again, if you remember, just 2 short years ago, COVID was the end of the world. Oh my God, the world's going to end. And in 2016, Donald Trump got elected. Oh my God, the end of the world. Remember Brexit? That's it. The world's over. It's over. The world's always ending every 2 or 3 years at this point. And I get you just get used to it. And then you say to yourself, oh man, I sold my stocks in 2000 when COVID, 2020, when COVID hit. I had to get out. And look what happened then. You're still above the COVID lows, technically. I mean, way above it. But again, guys, you're going to go through this every single time, every 2 years. The world is always ending. If you remember 2014, 2015, there was the taper tantrum. The United States lost its credit rating in 2015. You also had rates QE, QT, every single abbreviation in the book, and it's the same thing over and over and over again. The world's always going to end. We're going to go to zero, guys. I know. I hear that every day. I see it every day, whether it's CNBC, Bloomberg, or Twitter. It's always the world's ending. And that's where you have to have some perspective, guys. This shall pass, just like 2020. Sometimes I watch that investment club conference that I did, or it was a video I did for it was in March 2020, literally through the worst of the COVID situation, and this was in February. If you want to take a look at it on YouTube, it's on the channel. I have to maybe put the link on the comments or something. I'm not the best on YouTube. I'm sorry, but again, even then, I said this shall pass, and this will too. Again, it's a cycle. Business cycles happen. Restrictive policies happen due to high inflation when the economy just gets too hot, and it was too hot. 2021 was too hot. 2022 beginning was just too hot. Now we just got to slow it down. Do we continue to wait before buying heavy into blue chip stocks? Yep. As of right now, I'm holding pat. I still do my dollar cost averaging on SPY-G, which is primarily growth. SPY-G has Apple, Microsoft, Amazon, Tesla, Nvidia, Eli Lilly, United Health, JP Morgan, and Berkshire Hathaway as the main holders on that main stocks in that fund. So I get diversification. I still want to be in the market. But again, that's just the way I see it. Again, I'm not looking in terms of next year. I'm looking for 5, 10 years down the line. So when I have children, that's probably their college fund, so they can go to school. So I don't think it'll be worth it, but either way. Let's see, put call ratio on SPY is heavy. And that's the thing that's scary too. We had that just a week ago. Guys, just 2 weeks ago, we're going to get into the opening bell. Just 2 weeks ago, we broke 3,900 and I shorted. And guess what? I got rocked on this stupid bounce and it really pissed me off. It was right here, that break. I shorted for that break thinking that, hey, we're going to get to at least 37.50 or so. And why did this happen? It just happens. That's the bell, guys. Have a great rest of your morning. I know I discussed a lot today. Watching and watching and watching is all I'm doing today. If any opportunities come up, the team will let everyone know on the Discord. I will see you on Twitter. Have a great rest of your weekend. Great football this week. Cowboys play on Monday Night Football, but I'll be watching my fantasy team. Browns and Steelers last night was a really crappy game to watch. I didn't watch it, but I did have the Browns defense. So thank you for that late touchdown. Have a great day. See you guys later. Cheers.